Welcome to the Developer Journal. I am Sloan. Today we examine the friction between the massive capital expenditure pouring into artificial intelligence infrastructure and the quiet, messy reality of systems that break when nobody is watching. It is a world where frontier performance benchmarks often mask a growing sense of technical overextension. We will explore how Xiaomi claims to have slashed token costs by 60% with their latest agentic model, while a recent postmortem on Claude code reveals why these autonomous agents still fail in total silence. It is a high-stakes balancing act between the aggressive pursuit of scale and the immediate need for operational reliability. Beyond the software, we are tracking the massive financial pressure building as NVIDIA approaches earnings with fundamental strength that might not be enough to satisfy overbought technical charts. This tension between market optimism and engineering limits is reaching a breaking point. Vance, how do you see the math behind these massive shifts in deployment?
Sloan, the numbers are getting incredibly volatile, especially as we see companies ditching generative pre-trained Transformer 4.0 for local Llama 4 models to save millions on e-commerce descriptions. We are seeing a pivot where raw power is being sacrificed for predictable margins. And that shift tells a much darker story about current market sustainability.
Vance, that sustainability crisis is precisely why the arrival of the Xiaomi Mi Mo version 2.5 Pro feels like a shift in the tectonic plates. They are delivering frontier-level software engineering performance while slashing the token usage per trajectory by 40 to 60% compared to models like Gemini 3.1 Pro. This efficiency makes large-scale agentic workflows economically viable for the first time in a corporate setting. When you look at their use of the Kilo scaffold for repository-scale refactors, it becomes clear that we are moving past the experimental phase into actual utility. The financial barriers that once throttled these complex systems are finally beginning to crumble. What really stands out to me is the introduction of harness awareness technology. It allows the model to manage its own environment across trajectories exceeding 1,000 tool calls without requiring constant human hand-holding. This degree of autonomy suggests a level of maturity that could fundamentally change how we think about the role of a software engineer. The million-token context window and high scores in omnimodal reasoning represent a massive leap for a company often viewed only through the lens of hardware. Vance, looking at the raw output from their SysY compiler tests, does the engineering actually support the hype, or are we seeing another benchmark-optimized mirage?
The engineering is undeniably rigorous. Sloan, building a complete SysY compiler from scratch in just 4.3 hours while scoring a perfect 233 out of 233 against a hidden test suite is a remarkable feat. This proves the model is a legitimate threat to established frontier laboratories, rather than a mere toy. The performance metrics on the Software Engineering Benchmark Pro version further solidify this position. Achieving a score of 57.2 places its performance right alongside heavyweights like Generative Pre-trained Transformer 5.4 and Claude Opus 4.6. It is rare to see such high-level reasoning capabilities paired with such extreme token efficiency. However, the real test of this architecture lies in high-precision domains like analog electronic design automation. Using the model to tune Taiwan's semiconductor manufacturing company, 180-nanometer parameters requires consistency that many models lack. While the context window is expansive, maintaining coherence in those sensitive environments is where true friction remains. We must also consider how these impressive benchmarks translate to real-world stability when the guardrails are removed. It is time to pivot from the excitement of high-performance benchmarks to the hidden fragility and silent failure modes of these agentic systems. What happens when the autonomy we just celebrated becomes a liability in the dark?
The recent postmortem from Anthropic regarding Claude code reveals a terrifying vulnerability for any enterprise relying on stable performance. On March 4th, they lowered the reasoning effort from high to medium simply to reduce latency. This stealth update acted as a massive regression. proving that even subtle back-end tweaks can destabilize entire production workflows without warning. Things became even more problematic on April 16th, when a system prompt update restricted responses to just 100 words. While intended to keep things concise, it inadvertently slashed model intelligence by 3% on critical benchmarks. Seeing a major provider struggle with such basic prompt engineering side effects is a sobering reality check for everyone. To their credit, the team resolved these issues by April 20th and reset usage limits for all their subscribers as a form of compensation. It is a rare moment of corporate accountability in the Silicon Valley landscape, but it highlights a fundamental truth. We are building our most critical infrastructure on foundations that can shift beneath us at any moment. While the business implications are clear, the engineering failures behind these silent regressions suggest we need a radical change in how we monitor these systems. Vance, when you look at the specific failures in the command line interface and the orchestration logic, does this change how we should be testing agentic performance in the field?
The regression in version 2.1.10, one of the command line interface, is particularly revealing from a technical standpoint. A prompt cache error caused thinking blocks to clear after only 1 hour of idle time, effectively destroying the session history. This type of state management failure makes long context work nearly impossible to maintain reliably. To combat this, the Glinker orchestration logic has been updated to utilize per-turn token logging. This allows developers to detect silent performance drift and model instability in real time before it cascades into a total system failure. Relying on simple output validation is no longer enough when the underlying reasoning engine is constantly being modified. We also need to move away from evaluating agents using trivial toy tasks that only take a few seconds. The only way to catch these long context regressions is by using 30-minute real work sessions. These deep dives expose how models actually handle complex, multi-step trajectories over time, which is where current cloud-based models often falter. This persistent instability in cloud-hosted services is driving a significant shift toward local execution for mission-critical tasks. Many engineers are now moving away from the unpredictability of remote application programming interfaces. We are seeing a growing movement of bringing high-performance models like Llama 4 onto local hardware to reclaim both cost and privacy control.
The economic reality for small e-commerce businesses is changing overnight as they migrate away from expensive cloud services. We are seeing companies slash their monthly operational costs from $800 down to just $40 in electricity. By moving to local instances of Llama 4, they are reclaiming their margins while gaining complete privacy. Beyond the immediate financial savings, there is a massive win for regulatory compliance that often goes overlooked. Processing sensitive customer purchase history and competitor pricing within private infrastructure eliminates the hurdles of general data protection regulation compliance. This localized approach allows for deep personalization without ever exposing user data to the servers of a third-party provider. The performance metrics are equally impressive for teams managing high-demand launch weeks. Utilizing dual graphics processing units like the RTX 4090, teams are hitting 55 tokens per second for parallel jobs. This throughput allows for generating nearly 1,200 product descriptions every single hour, proving that consumer-grade hardware can compete with enterprise cloud solutions. It seems like a dream for any chief financial officer, but the path to 97% reliability for structured data is not a simple installation process. Vance, when you look at the gap between the base model and a fine-tuned Hermes 3 setup, does the engineering overhead start to eat into those savings?
The 50,000 monthly request break-even point is actually quite optimistic when you factor in the developer time. Reaching 97% reliability for JavaScript object notation output required moving from the base model to a Hermes 3 fine-tune of Maverick. Without that specific engineering effort, Reliability hovered around 88%, which is unusable for production. There are also significant infrastructure traps that can destroy your throughput if the hardware is not configured perfectly. If you under-allocate video random access memory, Llama triggers a silent central processing unit fallback. This bottleneck drops performance from 35 tokens per second to a measly 3 to 5 tokens, which can effectively paralyze an e-commerce pipeline. Maintaining high throughput on a single card requires 24 gigabytes of memory to stay in the green. While the electricity costs are low, the initial capital expenditure for high-end graphics cards creates a steep entry price. It is a calculated trade-off between paying for flexibility in the cloud versus investing heavily in your own local compute stack. We are watching a fascinating shift from the localized cost-saving strategies of independent developers to the massive capital expenditures of the giants. This focus on local compute brings us directly to the market valuations of the companies providing this underlying infrastructure. Specifically, we need to examine how the current bullish fundamentals are clashing with overbought technical signals for NVIDIA. Wait until you see the sheer heat on the price charts right now. We are looking at a 14-day relative strength index of 83.34, which is screaming that the stock is heavily overbought. While everyone is celebrating the $4.85 trillion market capitalization, the technical indicators are flashing red. The stock is currently near $199.64, but with a high beta of 2.33, the volatility is extreme. If the momentum breaks before the May 20th, 2026 report, we could see a 10 to 15% correction back toward the $170 support level. Market sentiment is sitting at 100% bullish, which actually creates a dangerous glass floor for the company. When expectations are this high, even a perfect report can lead to a sell-off if forward guidance is not flawless. There is zero margin for error as we approach the first quarter of 2027 revenue targets. I am also watching how custom silicon alternatives like the Google Tensor processing units are starting to chip away at the total addressable market. While the Blackwell architecture is the current gold standard, the competition is getting leaner and more specialized. Sloan, does the sheer scale of their cash reserves make these technical warnings irrelevant to the long-term story?
Vance, it is hard to ignore the momentum when the company has issued a massive $78 billion revenue guidance. This growth is being fueled by a 65.47% year-over-year increase. The Blackwell architecture is not just a product, it is the base of the entire data center infrastructure market. The financial efficiency we are seeing is almost unheard of for a company of this size. They are maintaining a 71.07% gross margin and a 55.60% net margin. This shows they have incredible pricing power over their customers, regardless of any technical indicators in the short term. With $96.68 billion in free cash flow, the company has an unmatched war chest to defend against any competitors. Analysts at KeyBank have already set a bullish price target of $275. That represents significant upside from the current 52-week high of $212.19. This dominance in the chip sector forces major cloud providers to rethink their entire infrastructure spending strategies. As we watch this shift, we need to see how these massive chip investments impact the balance sheets of big tech giants. Record-breaking sums are being poured into both satellite and artificial intelligence infrastructure. Amazon is taking a massive leap into the heavens with their $11.7 billion acquisition of Globestar. This move is a strategic necessity to accelerate Project Kuiper and finally secure the connectivity layer for their entire artificial intelligence ecosystem. By directly competing with Starlink, they are ensuring that their services remain reachable even in the most remote locations. The underlying strength of their retail and cloud empire is reflected in a robust 50.29% gross margin. While massive investments are currently weighing down the bottom line, The core business remains incredibly healthy. This tells us that their pricing power is strong enough to absorb the costs of building an entire global satellite network from scratch. Wall Street analysts are clearly feeling the momentum, with many raising their price targets to the $305 to $315 range. That suggests significant upside potential from the price of $255.08. As they approach their April earnings report, the market is betting on long-term infrastructure dominance. We see a company willing to trade short-term profitability for a permanent seat at the table of global infrastructure providers. This aggressive strategy leverages every bit of their 12.38% revenue growth to build a foundation that competitors will struggle to match. However, the sheer volume of this spending has caught the attention of some analysts.
Sloan, those infrastructure dreams are colliding with some of the most overextended technical indicators I have seen in years. The 14-day Relative Strength Index has hit a staggering 94.02, which signals that the stock is severely overbought. We are approaching the April 29th earnings report with almost zero margin for any kind of disappointment. The financial cost of this ambition is truly jarring when looking at actual cash movement. With capital expenditures ballooning to $131.82 billion for infrastructure, free cash flow has been squeezed to only $7.7 billion. That is a massive reduction for a company trading near its 52-week peak. While the gross margin looks impressive, the net margin of 10.83% tells a cautious story about operating efficiency. When you combine that thin margin with a stock price nearing $258.79, the risk of a correction becomes real. Investors are paying a high premium for these expensive satellite dreams. We need to watch if these massive capital outlays eventually provide the returns promised by the executive team. The pressure is mounting as other technology giants also navigate the expensive world of orbital connectivity. This brings us to a shift from the infrastructure-heavy approach at Amazon to the leadership transition and satellite strategies unfolding over at Apple.
Apple is entering a defining new chapter with the announcement of John Ternus as the next chief executive officer. A leadership transition that triggered a positive 2.5% market reaction and pushed the company valuation to a staggering $4.01 trillion, while investors signal their belief in his ability to maintain the brand prestige. That confidence is backed by incredible financial performance, including a 19.5% year-over-year earnings growth and a net margin of 26.92% on such a massive scale, which serves as a testament to their operational excellence as we approach the April 30th earnings report. Their strategic vision now extends into the stars through a new partnership to integrate the Amazon LEO satellite network into future devices, ensuring that the iPhone remains the premium choice for users who demand enhanced connectivity everywhere on Earth, and potentially driving sales well beyond the current market consensus. I wonder if those massive earnings can truly offset the liquidity risks that often catch your analytical eye, Vance, especially considering how those balance sheet numbers reconcile with the aggressive capital return program they are currently running alongside these new orbital ambitions, and whether the foundation is as solid as the hardware.
Looking past the $4 trillion valuation reveals a very aggressive financial strategy that leaves little room for error, since Apple is currently operating with a low current ratio of 0.89, indicating they are prioritizing returning capital to shareholders over maintaining deep liquidity in a high wire act. Even with $98.77 billion in free cash flow, the pressure to innovate in the satellite space is immense, while the partnership with Amazon is a tactical win for a company still playing catch-up to competitors with deeper vertical integration and a relative strength index of 67.04. The stock is nearing its 52-week high of $288.62, which creates pressure for the upcoming earnings to justify a price target of $297.71, as any small hardware delay or missed guidance could trigger a sharp and painful reversal. Ultimately, this journey from orbital satellite networks to internal leadership shifts highlights the broader theme of companies making high-stakes infrastructure bets, while simultaneously trying to pivot toward more efficient and localized execution of artificial intelligence, a balance of capital outlays and operational agility that will define the winners in this next era. We saw Xiaomi slash token costs by 60% with their MiMo version 2.5 Pro, while the Claude code Postmortem reminded us that efficiency means nothing if your artificial intelligence agents fail silently. These engineering trade-offs prove that even the most optimized architecture can crumble under the weight of unexpected edge cases during deployment.
Vance, that tension between aggressive scaling and operational reality is the defining story of this quarter, as massive capital expenditures meet the hard limits of model reliability. Companies are racing to build the future, but the technical market overextension we are seeing suggests that the foundation might be thinner than the bullish sentiment currently implies for these technology giants. Thank you for joining us as we navigate the complex intersection of finance and engineering, where the true cost of innovation is finally being calculated. Keep questioning the numbers and looking for the human story behind the code as we track these shifts together every day. We will be back tomorrow with more insights from the Dev Journal.